Picture Halloween, 1999. Across America, store shelves are waiting for one thing: Hershey's chocolate. But the candy isn't coming. Why? Because that summer, Hershey switched on a brand new $112 million computer system and flipped that switch at the worst possible moment, just as Halloween orders came flooding in. The system couldn't keep up. About $100 million of candy never shipped. The stock fell more than 8% in a single day. One system brought a giant to its knees. That system has a name, ERP, and tonight we're going to understand it. Welcome back. In our last video, we learned that the accounting information system always lives inside something larger. In this video, we meet that larger thing, ERP, Enterprise Resource Planning. I'm Professor Lamptey. Here's our path. First, what an ERP actually is. Then, the one big idea that makes it so powerful. Then, how it's built and how companies deploy it. And finally, the part that matters most for us, the risks, and whether it's all worth it. Let's go. Let's define it cleanly and write this one down. An ERP is one integrated system that runs the entire business on a single shared database. Read that back. One system, one database. The whole business. Most companies start out with separate programs, one for accounting, one for HR, one for sales. An ERP replaces that patchwork with a single connected system where finance, manufacturing, supply chain, and sales all work from the very same data. Here's the one idea that makes an ERP so powerful: a single source of truth. Without an ERP, every department keeps its own data in its own system. Little islands that don't talk to each other. The result? Sales says one number, accounting says another, and nobody's quite sure who's right. With an ERP, there is one shared database. A customer places an order, you enter it once, and in that instant, inventory drops, accounting records the sale, and shipping is notified. Everyone, everywhere, sees the same truth at the same time. Enter once. True everywhere. So how is an ERP actually built? Picture it like this. At the center sits one central database, the single core. Around that core sit the modules: finance, HR, manufacturing, supply chain, sales, each one reading from and writing to that same center. And here's the thing to file away for later. That shared core is the ERP's greatest strength and its single biggest control weakness. When everything is connected, a problem in one corner can ripple through the entire company. Let's name those modules because each one is a piece of the business. Finance, HR and payroll, manufacturing, supply chain, inventory, sales and customer relationships. And tying them all together is the dashboard. Think of it as the cockpit. One screen pulling live numbers from every module, straight out of that shared database. It's how a manager glances at the whole company: cash, stock, orders, production, in real time, in one place. Now, where does an ERP actually live? 3 deployment models. Know all 3. On-premise. The company owns the servers and runs the system itself. Maximum control, but expensive, and every update is your problem. Cloud. The vendor hosts it and you pay a subscription. Lower upfront cost, faster to start, reachable from anywhere. And hybrid, a blend of the two. The clear direction of the industry is toward the cloud. Here's what Hershey forgot. An ERP is not a switch you just flip. It's a journey with stages. You plan, scope, team, goals. You design, mapping how the business actually works. You configure, building and setting it up. You test before you ever trust it with real money, and then you go live with support for the long haul. Hershey rushed and went live at the worst possible moment. Respect these stages, and an ERP becomes a backbone that serves the business for a decade. Skip them, and you get a Halloween with no candy. And now the part this channel cares about most, the control risks. 1. Access controls. In a system where everything is connected, the question who is allowed to touch what becomes enormous. One careless login can reach across the whole company. 2. Segregation of duties. When a single system does everything, it's far easier for one person to both create and approve a transaction. So that separation has to be deliberately designed in. 3. Implementation risk, the Hershey problem, where the rollout itself is the danger. Here's the principle to remember. An ERP concentrates power, and anything that concentrates power concentrates risk. So, is it worth it? Let's be honest about both sides. The benefits are real. One source of truth, real-time reporting, genuine efficiency, and room to grow as the company grows. But the costs are just as real. ERPs are expensive. They can take months or even years to implement. They disrupt the business during rollout, and they demand serious training. Powerful, yes, but never to be taken lightly. Let's lock it in. 60 seconds. An ERP is one integrated system running on one shared database. It's built from modules around a central core and deployed on-premise, in the cloud, or as a hybrid. It's powerful, but risky to implement, which is exactly why access, segregation of duties, and implementation risk are always on the auditor's mind. If this made ERP click for you, subscribe. Next time, we step inside the business itself and follow the accounting transaction cycles, how revenue, purchases, and payroll actually move. Study hard. I'll see you there.